We got a little bit of a sell-off today in the market. It wasn't anything really major. I mean, if you look at the market overall, light volume, light pullback, was really no panic in the tape at all. So overall, I think it was a pretty measured, well put together pullback. It'll actually help put together some decent trade setups going forward, which after 2 days where the market rallied 200 points one day on the S&P and followed through the next day, it's kind of hard to find some really good trade setups. But if you get a little bit of consolidation, whether it's just a 1 day or a couple days, it'll definitely help to find some good long setups as this market bounce plays out. But enough from me. Let's go ahead and look at the charts here so you can see exactly what I'm talking about here. SPY. You have this line going right across here. It has represented some decent support and resistance going all the way back to June. At this point, it's support underneath the price. You have this cup and handle pattern that is formed. This is the cup part of the pattern, and then you got the handle part that is also formed. So really nice chart pattern there. If it pulls back to this level here, that could be a good place to try to stage a bounce. Now you also have this rising trend line, definitely worth watching as well. That you really don't want to see a pullback just yet to that rising trend line. If nothing else, maybe some consolidation, but you don't want to see a hard pullback because that will shake a lot of people out of their positions. But you always have to be ready for that kind of stuff. Now, the biggest one is this declining trend line going all the way back to the start of this sell. This goes back to the January highs of this year. Now, what's cool about this is that it's rejected price twice and in significant ways, where at which point the market was actually looking like it was going to push to new all-time highs, and instead it just made a quick U-turn and made new lows instead. So here you have the March highs. That one led to the lows that we saw in June. Then you got that sharp rally from late June through July and early August that resulted in a sharp decline that led all the way down to the October lows. Now we're bouncing. So where I'm really looking at, well, first of all, I'm going to be curious to see what happens at this white line right here. This white line represents the 200-day moving average. We did sell off there, but it was also coming together with the declining trend line off of the January high. So at this point, they're separated now. So what I'm looking for, okay, will that 200-day moving average put up a fight? And if it doesn't, then I'm really looking at, wanting to take some profits off the table at this 412 level if it gets that high. Now let's look at the Qs. Qs actually has a decent breakout here going on. And what's cool about today's pullback is that it actually gives you, if it can hold the support level, a decent opportunity to play the bounce off of this major support level that it broke through. So I'm watching that. And then you also have the declining trend line. It's not as strong as the declining trend line that we saw with SPY, namely because we managed to break through it before when we were trading off of this declining trend line. If you remember that one, we broke through that early in August, and then we sold off again. So now you have to redraw that trend line to show the new declining trend line as a result. But yes, nice double bottom here. It's pulled back to it. Now I'm looking for what happens if we can get that move up to 303, 304. That would be a good place to start looking at least tightening the stop losses or taking some profits off the table. Then you have IWM. And IWM is pretty interesting as well because it's sitting at that resistance right now. SPY isn't doing that, neither is the Qs, but IWM is. And what have we seen in the last 2 days? Rejection in price here. It has the 200-day moving average just underneath that trend line, which is what we also saw with SPY right here, yet it hasn't tested it yet. So IWM testing that declining trend line. So far, it's seen 2 days of rejection following the test of it. So that is something that's going to be very important to watch going forward. How does it respond tomorrow? Does it break through that? Because that's going to go a long ways in understanding a little bit more about those declining trend lines with SPY and with the Qs as well. Now, let's look at a couple of other things here before I wrap up this video. The first one is T2108. And before I get into it, make sure that you like and subscribe to this video and click the join button down below because I do these videos for members only of this YouTube channel. And you can get some really cool content that I provide about 2 to 3 times a day. So check that out by clicking the join button down below and becoming a part of this YouTube membership. T2108, this measures the percentage of stocks trading above their 40-day moving average. Now, when it gets up to this like 75, 80% level, well, you're starting to get overbought. And so we're sitting at 72 right now. Where did we get on previous rallies this year? Well, the dead cat bounce from June, July, and August, it got all the way up to 80s, okay, like 81, 82%. We're not quite there yet, 72%. How about the one from March? March, we're already above that one. That one got to about 65%. But what we have seen so far is the peaks from each of these, whether it's the one from December, the one from March, or the one from June, they've consistently gotten larger, right? So could we see a move this time around that takes the price perhaps all the way up to like the 90s? That would be extreme overbought. I'm hesitant to say that I think that's even a possibility at this point. You can see just looking at history, there's been very few times where we've done that. The COVID bounce off of the 2020 lows of March, that saw a significant bounce into the 90s. And yes, we're coming off of oversold levels as well. So that's probably the only precedent that could align with what we're seeing right here. But I wouldn't hold out hope that we're going to get to the 90s, but I wouldn't necessarily completely rule it out either. So the final chart that I want to show you is the VIX chart. Now this VIX chart, it's been really consistent about rejecting price at 33 to 34. If you go back to 2020, you can see, I mean, this has been a serious level of resistance. Each time it just continues to reject price. Did so again here in October, and I've been mentioning this for over a year now. This is the level where you see a lot of bounces ensue. What we've seen with March and what we've seen with August, when the markets fizzled out at the tops of their dead cat bounce rallies, is a VIX reading under 20. So you got the VIX reading as low as 18 in March, and you got it at around 19 as well in August. Right now we're sitting at 23, so there would be about another 20% drop at least to get us down to those levels. So keep that in mind. Is there room for this market to continue rally? Absolutely there is. We could easily see another 5 to 6% to the upside. But we have to keep in mind the fact that we're still in a bear market and that anything can change at any time. Part of technical analysis is reacting to what happens, not necessarily trying to make technical analysis align with our beliefs of how it pertains to the market. So keep that in your thoughts and in your processes that, yes, there's plenty of room for the market to continue running, but remember, we're in a bear market. Anything can happen. If you enjoyed this video, I encourage you to like and subscribe, and let me know down in the comments, how are you handling this dead cat bounce? Are you continuing to add exposure here, or are you just going to stay put and see where the market wants to go from here? Let me know. Make sure to click the membership button down below where it says join, and thank you guys, and God bless.